I'm a counselor with the California Capital and the Women's Business Center. I help business owners put together budgets and loan packages, help them obtain financing, I also help with various types of financial analysis, including cost accounting. My background is I spent the first 5 years of my career as a business loan officer, and then with a bank, and then finished my MBA and went over to the corporate side and held positions such as finance manager and vice president of finance, and finally ending up as chief financial officer of several companies in different industries. And for the last several years, I've been doing independent consulting, and started out with Small Business Development Center, and then more recently, I've signed up as a counselor with the California Capital and the Women's Business Center. So our topic today is budgets, which is, it's an important topic. Budgets, well, I recommend that all my clients do a budget, even if they're not applying for a loan. It's an important planning exercise. I once worked for a CEO who used to say, a failure to plan is a plan for failure. And actually, I got tired of hearing that. But the budget is kind of a primary planning exercise, and it kind of forces you to estimate how much sales revenue you're going to have, and expenses, and to determine if the business is going to make a profit. So I'm going to share my screen now, and I hope this in. Okay. So since we're budgeting for food-based businesses, I've got a nice picture of food here. So there's various types and purposes for budgeting. If you're starting a new business, a new restaurant, it's very important that you put together a budget for your startup costs. Make a list of everything you're going to need to pay for to start the business, everything you're going to need to spend before opening. And then it's important to do an operating budget, which is a sales revenue and expense forecast by month. And then if you're going to apply for a bank loan, you need to put all of that together into a cash flow forecast, which combines the startup costs and the operating budget with assumed capital sources, and it forecasts available cash balance, the available cash balance monthly. So it will show if you're going to be short of cash. It basically shows how much cash you might need to borrow from lenders or otherwise raise capital. So we'll start out with a little look at representative startup costs for a restaurant. Now, these are just representative. Every restaurant is going to be different, but one of the big costs is building renovations. And if you're moving into a new building, it can be pretty expensive, but you might be able to get what's called a TI allowance from the landlord. TI stands for tenant improvements, and sometimes those allowances can be pretty significant. It's the money that the landlord essentially gives you to complete the interior of the building, or if you're moving into an existing space, maybe it was another restaurant prior to your moving in, but you probably want to remodel it, and you can maybe negotiate a TI allowance from the landlord in that situation, although it wouldn't be as big as with a new space. So, but the tenant improvements, TIs, or building renovations can be pretty expensive, from $10,000 up to $1 million or so if it's a big restaurant, a big restaurant chain or something like that. Of course, you're going to need to buy cooking equipment, and virtually every piece of cooking equipment is going to cost $1,000 or more. And so there's a list here of, again, just kind of the representative ranges, but you really need to do your homework and determine how much you're going to spend for each item. In the River District of Sacramento, along Richards Boulevard and on 16th Street and 12th Street, there are quite a few different restaurant supply stores that you can purchase equipment. One of them is called Chef's Toys. It used to be called Trimark, but then it moved across the street and changed its name. But so you can go into one of those stores, look at what you want to buy, determine the prices, and then go on the internet, look for them on the internet, and you may be able to find used equipment. A lot of restaurants, unfortunately, have gone out of business recently, so it's always a good idea to see what you can get used, and save money that way. So, but here's a list of representative costs of various types of cooking equipment, refrigeration equipment, $3,000 to up to $100,000. Cash register and POS system. POS stands for point of sale. That's the computer system that records sales and issues the bills. And so you have to be, fully equipped. A lot of that is done on computer now instead of cash register. But let's see, let's move on here. Security system. You probably need something, whether you have video cameras or just an alarm that's monitored. Of course, tables and chairs, interior decoration, signage, and don't forget what you're going to need, the expenses you'll need to just get everything going as far as marketing, licensing. You'll need to buy inventory of food and product and dishes, etc. So those are some of the smaller items, but still can amount to a significant amount of funds. For a food truck, it's going to be a little different. One of your biggest costs, of course, is going to be purchasing a food truck, and you can pay, $100,000 or more for a brand new, fully equipped one, or you can buy something used, save a lot of money, but you'll have to retrofit it, and so you're going to spend, $25,000 to $50,000 retrofitting. You'll need a generator. Again, you'll need POS system and hardware. Paint. Most food trucks, of course, have a vehicle wrap that advertises their business. And then you're going to have to buy food to start out with, of course. So once you've determined what your startup costs are going to be, then you need to move on to, a few more startup costs here for a food truck. But once you've determined all these, you'll need to move on to doing an operating budget. And an operating budget is, I think, important to do even for an existing business. It's a good planning exercise. And basically, it consists of a forecast by month. So, I do them on spreadsheets, and you've got one column for each month, 12, 24, or ideally 36 months out. You're going to forecast sales revenue for food and beverages, ideally separately, one line for food, one line for beverages. You're going to forecast cost of goods sold, or abbreviated COGS, which is the cost that you pay for food ingredients and beverage products. Labor expense, of course, is another big item that includes payroll tax, workers' comp, and benefits, and then all of the fixed and overhead expenses, rent and insurance, and other costs of keeping the restaurant open. So for the sales revenue forecast, an existing restaurant that's been in business for several months or even years can use kind of the simple method where they look at historical sales revenue per month and then forecast that into the future. It's important to split it between food and beverages because the cost of goods sold will probably be a different percentage for food versus beverages. But for a startup restaurant, especially one that wants to get a loan, you might need to do a more detailed approach that might be required by the lender. And to do that, you do something like take the number of tables in the restaurant, estimate what your average bill for a group at a table would be, multiply that times the number of tables, estimate your table turnover. In other words, how many customers you'd have at each table each day. So the number of tables times the average bill times the table turnover will equal your average revenue per day. Multiply that by 30 to get your monthly revenue. Again, it's important to split that between food and beverages in order to calculate cost of goods sold. So cost of goods sold, or the abbreviation COGS, that's one of the biggest expenses. That's the cost of food ingredients and beverages that you purchase. Most restaurants will spend between 25% and 40% of their sales on ingredients. 30% is kind of optimum. And so if your cost of goods sold is 30% of sales revenue, that means the price of each menu item should be more than triple the ingredients cost. Often beverage cost of goods sold is lower, 20 to 30% of sale price. And so that means beverages should be priced at 3 to 5 times cost. And your overall average cost is influenced by the mix of food versus beverages, but ideally should be around 30% or less if possible. But it's important to verify what your cost of goods sold is as a percentage of sales, and not just assume 30%, because you could be wrong. So what it's best to do is divide the ingredients cost for each menu item by the price to determine what your cost of goods sold is as a percentage of the price, at least for the major items, to be sure that you're pricing them appropriately and you're keeping your cost of goods sold at a reasonable level. Labor expense is another big component, of course, of running a restaurant. Ideally, your total labor expense should be about 30% of sales. That's a fairly typical number. Total labor expense includes hourly wages, management salaries, payroll taxes, workers' comp insurance, and benefits. Of course, payroll taxes include FICA, which is Social Security and Medicare, and unemployment, federal unemployment, and state unemployment, FUTA, SUTA. So those items combined, your payroll tax is going to run about 9% of your base wages. So once you've estimated your base labor cost, you can add on 9% for payroll tax. Workers' comp expense is going to run somewhere around 4 to 5% of payroll, and that could be higher or lower depending on the claim experience for a restaurant that's been in business for a while. Smaller restaurants don't offer benefits often, but if they do, health insurance and 401k expense would be the two typical ones. And if you want to offer those, you'll just have to, talk to a vendor, a broker, to get an estimate of what the cost will be. So for labor expense, I would encourage you not to just assume it'll be 30% of sales. I would encourage you to do a deeper dive, do a more granular approach where you would estimate, you do a buildup based on hours per day that the restaurant is open. So if you've got a restaurant that's open from 11 in the morning to 11 at night, that's 12 hours per day. If it's open 7 days per week, 7 times 12 is 84. If you want to have 3 staff positions, for example, cook, waiter, busboy, continuously, 3 times 84 is 252 total staff hours per week. And if your wages are $18 on average, that means your total weekly wages are $4,536. And then to come up with your monthly amount, you multiply that 4,536 by 52 and divide by 12. So your monthly wages are $19,656. And then you would add payroll and tax and benefits to that. And this is just representative. I mean, every restaurant's going to be different, and you'll probably have a different wage rate for each position. So you might want to do this buildup for each position. And that way, if you are trying to get a bank loan, when you go in to get a loan, you can show the lender that you've done your homework and you've really done a granular approach to building up your labor cost estimate. So there are various metrics, financial metrics, that you can look at to evaluate performance of a food-based business. Sales minus cost of goods sold is what's called gross margin. So if your cost of goods sold is 30%, your gross margin would be 70% of sales. And a typical metric for the restaurant industry is what are called prime costs. So your cost of goods sold plus labor expense is what is referred to as prime costs. And sales minus prime costs is contribution margin. That's basically what you have left over after paying for cost of goods and labor, and that's what you have available to pay for your overhead expense. So for a full service restaurant, prime costs should be 60 to 65% of sales, not over that. And for fast food restaurants, prime costs should be less than that, because they don't have people waiting tables, so labor costs would be less. And then for a food truck, perhaps even less than that. Then the third component is your fixed and overhead costs. And there are quite a few. The biggest one is probably going to be your rent. You're probably going to pay $2.50 or $2.50 per square foot of space. So, 36,000 up to, over 100,000 per year. And then utilities are going to be a big expense. You got to run all those refrigerators and run your air conditioning, $10,000 to $25,000. Marketing and advertising, a lot of established restaurants spend around 3% of sales on marketing and advertising. But for a startup, initially you want to spend a little more than that, especially with your initial advertising and marketing push. Credit card processing fees are going to run 2 to 3% of sales. Smallware, that's basically dishes, plates, things like that, could also run around 3% of sales. For insurance, $4,000 to $10,000. But before you start a restaurant, go to a broker and get a quote for insurance. Other expenses, licenses and permits, entertainment. Entertainment can be anything from $0 to $50,000 a year, depending on whether you have live entertainment or what you do. Professional fees, you're going to want to pay a tax accountant to do your taxes. You might have an outside accounting service to just do the bookkeeping. POS system, you're going to pay probably a monthly charge for your POS system. Most software packages are charged monthly now. And there's more. Repairs and maintenance, don't forget that. I mean, you will need to fix things as you go through the year, even in a new restaurant. Bank service charges, pest control is kind of important because you definitely want to probably have a service take care of that, and supplies, security, office supplies, etc. Janitorial services, if you're going to have somebody come in and do that. Laundry and linen, if you provide uniforms or have tablecloths, napkins, etc. So here's a performance goal that I think is valid. So if your cost of goods sold is 30% of sales, and your labor expense is 30% of sales, and your other expense is your overhead or fixed costs are 30% of sales, then you'll have a profit margin of 10% of sales, and that's a good target to shoot for. So it's kind of 1/3, 1/3, and 1/3 for each of these expenses. And if you can hit a 10% profit margin of 10% of sales, you're doing well. And I want to switch screens right now and kind of put all this together and show you what we use for cash flow forecasting. If I can find it. So this is a spreadsheet template that we use for cash flow forecasting. And if you're going to get a bank loan, you'll need to prepare at least a 24-month cash flow forecast. But it's a good idea to do it anyway, even if you're not looking for a bank loan, because it's a good planning tool. So we start at the top with food sales and beverage sales. Now I've just put some basic round numbers in here for examples. And then we come down to the cost of goods sold section, and it's got functionality here where we'll take a percentage of sales revenue, 32% for food, in this case 28% for beverages, multiply that times the food and beverage numbers to come up with your cost of goods sold numbers, and then total them into your total COGS, subtract that from sales revenue, and you get your gross profit, which in this case is $28,000. And then in the section down below, we're estimating operating expenses, so advertising and marketing, bank charges and fees, etc. In expenses like insurance, we like to put them in the month when they're due, because that's a big expense and you might pay that once in a year. Other expenses are spread pretty much equally monthly, and the spreadsheet has a functionality to when you put something in a gray cell here, it'll just spread it across. Scrolling on down, I mean, rent and lease, of course, your rent is a big number. Smallware is in at 3% of sales, again, with a formula that calculates it based on sales. We're putting wages in at 30% of sales, and then payroll tax at 9% of wages. And this, then we get a total expense number, subtract that from gross margin, gives us net ordinary income. Then we've got a section down here for principal on a loan, another section for capital expenditures, which could be your startup expenses for a startup. And we'll go back to the first page of the file here. So on this first page, you have the ability to put in the name of the restaurant, the loan amount requested. In this case, I stuck in $80,000 for an example, and the amount of cash you currently have. And so what it will do then, going back to projected cash flow, is it shows the initial capital purchases as an expense, but it also adds in the loan proceeds in your opening cash to calculate your ending cash balance for each month. And in this case, we're showing a positive cash position at month end for each month going forward. Now, with some startups, it's when you do a cash flow forecast for a new business starting up,
Hey,
instead of
Don,
having, yes?
we can't see the spreadsheet
Oh, really? Oh, I think I'm still,
on the
well,
PowerPoint.
It says you are screen sharing. That's interesting.
I think you have to stop sharing that screen and then bring.
Oh, okay.
Yeah.
Okay, I apologize. Let's try that again. Okay, I'll go over this. Okay, can you see the spreadsheet now?
Yes, thank
Okay,
you.
so, well, I'll start at the top again and just quickly go through it. So we're starting off at the top here with food sales by month. And I've just put in some round numbers here, for example, $20,000 per month. And in this example, we've got the same amounts in every month, and the spreadsheet has the functionality when you put something in the first month, it just spreads it across the 12 months. But for a startup, it would be much more realistic to kind of have a ramp up where you'd start with a lower amount of sales and increase it every month until you are up to the level, at least the break even. Then we've got the functionality here where we put in a percentage for COGS, cost of goods sold for food, and it multiplies it by the sales to get the $6,400 for cost of goods sold. Beverages, we put in a 28%, again, multiplying it times the sales amount. So then we've got total cost of goods sold, $12,000 subtracted from the total sales, leaves a $28,000 gross profit. And then we're estimating the fixed costs or operating expenses, overhead here. Advertising's at 3% of sales, bank charges and fees at 3% of sales. Smallware is, plates, silverware, those kinds of things, again, 3% of sales. Wages I put in at 30% of sales, and then payroll tax at 9% of wages. So we've got total expenses, subtracts that from gross margin to get net ordinary income, and then we've got a section down below where we put in principal on the loan. And initial capital purchase, I've put in $100,000, which is just kind of a round number. If this was for a startup, you might have $100,000 in initial expenses. And then on the first page, we've got a space here to put in the loan amount requested. I've put in $80,000. Space for initial cash on hand, $20,000. And if we go back to the first year forecast, it actually calculates your cash position at month end, basically assuming you started with an $80,000 loan and a $20,000 cash infusion of your own. So you put in $100,000. And so it shows your cash level at the end of every month. Now, if this was a startup, a true startup, and you had started with a lower sales amount, you might show losses for the first 3 months while sales were ramping up, and you would look at your biggest negative cash position, and that would kind of tell you whether you needed to adjust your loan amount or put more capital into it. So this spreadsheet, we can send these out, so you have this, and if you need assistance in putting this together, I'm available, or other counselors at the Women's Business Center can help you create this cash flow forecast. Okay, now I want to switch back to where I was before. Okay, So I wanted to talk a little bit about the requirements for getting a loan, and unfortunately it starts me over at the beginning, so I'll just run on down to that. So for a startup restaurant to get a loan, there's several things that are required. A written business plan will be required and needs to be complete and well thought out, and you need to include sections about analyzing your competitors. It's important to identify your competitors and your strengths and weaknesses in comparison to your competitors. A lender's going to want to see that you've given that some thought, and how you price your menu items versus your competitors, what your location is. Do you get good visibility? Are you in a shopping center with good anchor tenants that will attract a lot of foot traffic walking by? And we can provide templates for a business plan, and we can help you write a business plan. The lender's also going to want to see a 24-month cash flow projection based on a reasonable set of assumptions, using the format we just reviewed. And again, reasonable set of assumptions. So with a startup, you'll need to show kind of a ramp up as sales increase for your business after you start. The lender's also going to want a cash contribution of your own cash equal to 20% of the amount of financing needed. So you do need to have enough cash to put in at least 20%. Now, if you have multiple people investing in a restaurant, anybody who owns 20% or more will need to probably submit personal financial information, personal tax returns, and sign a personal guarantee. And if so, some people come in and they say, well, my aunt or my uncle is going to provide, $20,000. That will have to be documented as either a gift or as an ownership percentage. And then for a startup, the lender is going to look for income from secondary sources. Sometimes I tell people, don't quit your day job, because that income from secondary sources is important to qualify for a loan for a startup, because your ability to generate revenue through the business has not been demonstrated. There's a saying in the startup community, I guess, sad but true, and that is, behind every successful entrepreneur is a spouse with a six-figure income and good health insurance. And that's not absolutely a requirement, but that's the kind of secondary income that that lenders are looking for. A lender will also look for 2 years of experience in the industry or some other management experience that shows that you have the ability to manage a business. Lenders also look for training and technical assistance of the type that California Capital and the Women's Business Center provides. So if you've gone to some workshops on managing a business, writing business plans, et cetera, offered by California Capital, and if you've got counselors helping you, then that amounts to the training and technical assistance that is looked for. Lenders like to see a minimum credit score of 650 or more, or a reasonable explanation of why it might be less. And as I said, you will need to submit tax returns, personal tax returns, and a personal financial statement showing all of your assets and liabilities. And then for an existing restaurant loan, often a written business plan is not needed unless they're expanding, opening a new location, or just moving to a bigger location, doing something new. If they just want to buy a loan for buying some upgraded equipment, usually you can get by without a written business plan. But a lender will require a 24-month cash flow projection, again based on reasonable assumptions, but also consistent with the historical financial statements and operating performance of the restaurant. So the lender will want you to submit 3 years of tax returns and financial statements, and they'll look at the 3 years of historical profit and loss statements and compare the cash flow projection to the historicals to be sure that the cash flow projection is reasonable. They'll usually look for the restaurant to have been profitable for 2 out of the last 3 years, or if not, a reasonable explanation as to why not. And of course, again, this last year has been kind of crazy and difficult for a lot of restaurants. And so, lenders can go back to 2019 and look at the performance then as an indication of future performance. Although the big question now is, how soon will things get back to normal? And for some of my restaurant clients, I've helped them put together budgets and cash flow forecasts where we look at analysis of multiple scenarios. So, we do maybe 4 different scenarios in the budget. One is kind of just steady state, staying with everything staying as it was, say, in January. That's a little bit pessimistic. So then we looked at a 6-month scale up back to normal, a 9-month scale up back to normal, and a 12-month scale up back to normal. So that's helpful as a planning exercise. And so when the lender is analyzing your cash flow forecast, they're going to look for cash flow that's more than sufficient to make loan payments and that is supported by historical financial statements. Instead of the 20% cash contribution required for a startup, the owner's equity in the business may substitute for a cash contribution, and the owner's equity is shown on the balance sheet. And we haven't talked about balance sheets because we've been focusing on budgeting, which is really kind of a forecast of a P&L statement. The balance sheet is another financial statement. It shows your assets and your liabilities at a given point in time. And I have a lot of businesses come in that want help getting a loan, and I ask me to send them their balance sheet. And usually it's, if they're on QuickBooks, they can just download it from QuickBooks into Excel and send it to me. And a lot of times their balance sheet is a mess. It's got, negative numbers. They haven't reconciled their bank account. I had one lady who hadn't reconciled her bank account in 4 years since she started the business. And it's important to look at your balance sheet periodically. I recommend monthly, and reconcile the numbers on it. In other words, go through and verify that the numbers are right. And if the cash balance on the balance sheet that comes out of QuickBooks is not the same as what you've got showing on your bank statement, you need to determine why. A lot of times it's just checks that were issued and haven't cleared yet. But any other numbers on the balance sheet that you can verify, you need to do that, whether it's the loan balance is verified on a loan statement, your inventory numbers you verify by taking the physical inventory, et cetera. It's important to have the balance sheet accurate. So when you go into a lender and show them the balance sheet, hopefully it will show positive equity. Total asset values minus total liabilities equals owner's equity. And if you've got a substantial owner's equity, that takes the place of the cash infusion required for a startup, because that's the amount of capital you have tied up in the business. And they'll also look for, a lender will look for a minimum credit score of 640 or higher, or a reasonable explanation of why it's less. And again, you'll have to submit 3 years of business tax returns, financial statements from QuickBooks, and for anybody with a 20% or more ownership in the business, they'll want to see personal tax returns and personal financial statements. And if you need help, putting the package together or putting a budget together, counselors are available, including myself with California Capital, to help you do that. And again, in that step 6 in your application process, if that's what you need to specify that, and you may be able to specify who you want to work with, in which case you can put my name in, and I'd be happy to help you put together a budget, cash flow forecast, complete loan package, look at your balance sheet, and help you clean that up if it's got issues. And just another note, going back to the cash flow forecast, that can become an important planning exercise, because after you've created it and presented it to your lender, if that was necessary, going forward you can update it. Every month you can kind of start it over with your existing cash position, make any changes you think as situations change, and it'll roll forward and give you an estimated cash balance for each month end, so you can see if you've got enough cash in the company or whether you're going to have a shortfall. That pretty much finishes my presentation. So, and I'm not sure what the process is for taking questions.